What have you been making of the economy so far this year?
Well, I think the slowdown is coming. It's not, I think, going to show up as much in the first quarter GDP report. We've got a strong growth in inventories. We've got better than expected trade numbers. So I think we could be between 2.5% and 3% on GDP growth for Q1. But as you can see from the existing home sales report, you saw this in housing starts last week, the housing industry is not really showing any pep here. Vehicle sales, I think, are also topped out. I think the benefit from tax cuts last year is fading. So we really expect that by the time we get to the third quarter, year-over-year GDP growth will be down at about 2%. And that's kind of where we're going to stay for a while here. So we don't see a stall out, we don't see a recession, but we do see a definite slowdown in growth occurring during this year.
As you say, the slowdown is coming. What will be the signs that it's imminent?
Well, I think you just have to look at the pieces like housing, autos, retail sales in general. That'll tell you the story. I mean, in many ways, it's here already. The only reason that the GDP number is going to look pretty good for Q1 is because of reversal in trade. But overall, we're already seeing this in the data. But, it's not that scary. I think when you say slowdown, people say recession. But why do we expect that it has to be a recession? I know that a 60-year-old is going to run slower than a 30-year-old, but he can keep running. He could still be running at 80. And so I think this is a very unusual expansion. I think it could last a few more years just at a slower pace.
I suppose the idea is that we've never had a business cycle this long.
That's right. And why should we expect such an unusual business cycle to die a conventional death? I mean, if you look at it, real interest rates are not that high. In fact, they're very low by historical standards. The cyclical sectors are not overextended. There's no real hype. There's no real hot sector of the economy. These things actually give you a measure of protection. So go ahead.
But what are the reasons for the strength? I mean, I agree with you that we see some strength in the data. At the same time, wages are inching higher. It's not exactly like we've had an explosion in wages. Inflation is in check. We're not seeing massive beats on anything. The only other part of it that you might want to take into account is the stock market, which has been grinding higher, but that benefits just a certain proportion of people.
Well, that's right. And in fact, that's kind of the secret of why this expansion is slow but so long, because what's going on is asset prices are going up. That's the one thing that quantitative easing has definitely achieved. It's pushed up asset prices. But 75% of U.S. assets are held by the top 10% of households. So that is not really benefiting most Americans. That means you're not seeing this surge in broad consumer spending that would lead you to sustain stronger growth. And that's why we're sort of just slowing down to this relatively slow pace.